After riding for nearly 6 kilometers from our farm, we have come to a beautiful place, which is the forest department's small land patch. And we look for it's too sunny right now. So, to have a Zoom chat, we'll look for a very beautiful location here where we have shades. Climbing in a beautiful place, beautiful location. We found out. Wow, come on, Randy. Very good. So, in today's international tax world, we have seen certain very good developments. Budget that government of India had come out to boost the GCC space in the country. India is set to become the GCC capital of the world. It's already leading in the world. Government of India and the state governments are very much supportive for the GCCs. They are helping them in a lot. One of the places which required some plugging in was the taxation part, because an investor who is coming to India, it's very much cost conscious. It has to reduce its cost. Of course, quality pool is there in the country, but they are also cost conscious. Tax cost is one of the leading costs when it comes to any kind of entity operating business in India. So government of India has come out with a very beautiful initiative, what we call a safe harbor rules for GCCs, which are going to help to mitigate the tax issues on GCCs, reduce the tax litigation, have a tax certainty, which is very important for an offshore. So today we have a very important, eminent personality with us, Mr. Nilesh Modi, who is author of the only commentaries for at least 10 years on international tax in India, even before BCAS was come out by any Indian author. So we have Nilesh Modi with us, with whom I am going to initiate discussions on how these draft rules are going to be, once they get formulated, are going to be very much beneficial. Hi Nilesh, good morning to you.
Hello.
How are you, Nilesh?
Good morning, Alok. I'm doing well, Alok. How is the weather in Jaipur?
The weather is quite. It's a mixture of the. It will be hot in some time. Right now it's cold, and it's 7:45 right now. We started from our
Great.
farm at around 7:10, and it took us 30 odd minutes to cover 7 kilometers, and we have come to a very picturesque location. I'll just show you the location here. It's a picturesque location. It's a kind of small valley where I have put up my this setup, Nilesh, and
Wow.
the horses are tied up close to this place where there is a bit of green pasture. So we tied up them over there because they will be bored by the interesting tax talks which we are going to do it now. So in the meanwhile, meanwhile we do our discussion, and we all get some understanding from you on the topic. Our horses will be able to get their breakfast done.
Okay.
So, for the sake of introduction of everyone, Nilesh Modi doesn't need an introduction, but he's the man whose commentaries have guided us for close to 18 years odd, Nilesh, on international taxation. The commentaries on international taxation have been quoted by certain courts also while pronouncing the judgments. In my very small career with Big Four, I never remember that whether any advisory in those days have ever gone without making a reference to the commentaries by Nilesh Modi. So, Nilesh, thank you so much. And it's the time where a person like me and likewise professionals in the fraternity are looking up to you to have your mind-boggling analysis and thoughts on the new Income Tax Act, which is coming up. Nilesh, today we will be starting with the very interesting development which has happened. Safe harbor rules which have been announced for GCCs, and we would be requiring your guiding torch to decipher these safe harbor rules and to have some kind of guidance on what all more things could be done by the government and by the taxpayers to have very efficient implementation and benefits to be derived out of these safe harbor rules. So up to you, Nilesh. Now, please throw some light on these new rules.
Hello. So thank you, Alok, for for inviting me. I understand this is a first podcast, so I'm glad that I'm making my debut also on your debut. So, Alok, in the next few minutes, I will be discussing my personal views, which are not of my organization or its affiliates. Having said so, on 1st Feb, the finance minister has announced the mother of all reforms when it comes to transfer pricing. India has been for long the GCC capital of the world. At the same point of time, there were many mid-sized to small MNCs which were wanting to come to India to set up their GCCs, particularly in the space of software development, IT-enabled services, KPOs, and R&D, which is directly or indirectly linked to software development. Now, for long, one of the key concerns of MNCs has been transfer pricing. Transfer pricing because of the fact that there is always a debate or a subjectivity in terms of what is the markup that the Indian GCC should charge to its overseas affiliates for the services that are provided. Now, with one stroke of pen, the finance minister has made it very, very attractive for MNCs to set up GCCs in India by providing that the minimum margin that should be offered for tax by the GCC should be 15.5%. This is applicable if the turnover does not cross 2,000 crores annually, and the scheme will be available for 5 years at a stretch, beginning from 1st of April 26. Now, obviously, this is going to have a multiplier effect on the economy. More the number of GCCs, more the employment, more the income tax collections for the government, because obviously, employees in the GCC, which constitutes a majority of the cost, will earn salary on, and the salary income tax will be payable. More the earnings, more the spending, more the GST collections. There'll also be immense benefit on account of inflow of foreign exchange to the country, which will help in terms of stabilizing our exchange rates as well. So all in all, I think this is going to prove extremely beneficial to India. It is going to take us very rapidly to our dream of becoming a developed country.
Yes, Nilesh. This seems to be the intention of the government. Already in India, we have so many GCCs which have been set up in Hyderabad, Bangalore, Pune, Mumbai, Gurgaon, and tier two cities. My hometown, like Jaipur, also, which has some GCCs already set up long back, but they are eyeing for more GCCs. Gandhinagar, Ahmedabad, Nagpur. There are many states in the country which are trying to attract investments in the GCC space, and tax cost has been one of the key concern for any foreign investor when it is coming to India in terms of quantum, in terms of more importantly, certainty. So, Nilesh,
Right.
here comes a point that already we have a mechanism of APA under the Indian income tax law. A point which comes to my mind right now is that fine, it is 15.5% today if we go and opt for the rate from 1st of April 26. But what would be the fate of the APA or choice given to the investor? He would have signed an agreement with the government of India on say 16.5%, and just 1 or 2 years have been elapsed on that APA. Would they be given a choice to bring down their margins to 15.5% or not? Because they may feel that fine, it's good for future, for their future, but present, how they even can benefit out of these provisions. Your thoughts on this, Nilesh?
So great question as always, Alok. Now, we must understand that the reforms announced by the finance minister considers that the minimum margin should be 15.5%. So if the margin is 15.5% or more, then there will be no TP assessment or transfer pricing assessment that will take place. Obviously, if the APA is signed as 16.5% in your example, then in that situation, the customer contract which the GCC has signed will also have a margin of 16.5%. So it's not only the APA, it's even the customer contract. So in this situation, it is important for the GCC to have a dialogue with the government or with the AP authorities that how can it take the advantage of the safe harbor regime. It is important to understand that firstly, the customer contract will have to be modified to bring down the margin of 15.5%. And there has to be business reasons to bring down the margin. For instance, India might be becoming uncompetitive if the margin remains 15.5%. So there should be a business rationale to modify the customer contract. And then there should be followed with perhaps modification of the APA or some other mechanism will have to be worked out. But currently, the draft rules which have been brought out by the CBDT do not encompass the situation that you are talking about, Alok. But government is very, very open to understand the concerns of the industry and guide the industry in the right direction.
Okay. Thanks, Nilesh, for this insight. I think definitely the rules are at the nascent stage, and as we move forward, looking into the requests made by the investor and how we move forward, certain points will definitely be taken care of by the government. Dilesh, one more thought comes to the mind that right now only four categories of GCCs have been covered into this. I would request you to throw some light on these categories also for the sake of the listeners.
Yeah. So, as I mentioned earlier, there are four categories of GCCs which can qualify for no transfer pricing audit. Number one, IT-enabled services. Number two, IT services or software development services. Number three, KPO services. And number four, R&D services, which are directly or indirectly linked to software development. Now, the government has found that majority of the GCCs that have been set up in India pertain to these four categories. So presently, I guess that the reform has been for these four categories. And as the government finds that there are GCCs, say in the pharma R&D space, that are also keen to enter India, we might find that there may be a very attractive safe harbor regime that will be prescribed for such type of GCCs also. There are safe harbor regime for some other transactions like corporate guarantees, which too might see some kind of reforms going forward. But perhaps this is the start.
Yes, Nilesh, because I do not really see much into the corporate guarantee space and other points. It's something more to be deliberated further and see how these things shape up, and then how the investor concerns will also be taken care of. Nilesh, you have mentioned about the turnover limit of INR 2000 crore for a GCC to derive benefit of the safe harbor regime. A thought comes to the mind that what about corporate restructuring? If a M&E group from offshore uh, opens up, say, three GCCs in India, it would be having different operations, different nature of operation in each of the GCC. Could they be able to split up and take advantage of this INR 2000 crore per GCC? Or would the revenue authorities go in and probe in and say that ultimately what is the objective of the GCC is to benefit the whole group? The GCCs are set up not just for one legal entity, but to benefit the whole worldwide group. That's the, you say, spirit of a GCC. So how would these corporate restructurings happen, and how revenue authorities are going to uh, take this up to judge the turnover and to give them the benefit of a GCC safe harbor?
So, Alok, any such restructuring that is splitting up a big GCC into different companies, each having turnover of less than 2000 crore, is usually a very mammoth exercise. It is business disruptive as well. Now, what I suspect is if there are such mega GCCs, it is better for them to apply for APA. It is expected that APA margin, which earlier used to be, say, between 15 to 17% for the categories that I mentioned, will also come down perhaps to 15.5% or lower. So that might be one option that may be considered by such mega GCCs. The government is also wanting to fast track the APA program, as what has also come out in FM speech. So I would recommend always that instead of doing anything innovative or business disruptive, which might be falling foul of anti-bias regulations, it is better to play straight. As I say, play with a straight bat and runs will follow. So play with a straight bat and try to go for an APA, which will meet your requirements and which will perhaps be more attractive than the safe harbor margin also, which has been prescribed.
Yes, very
I must
much.
also add, Alok, that it's not only the safe harbor margin. Now, the government has also provided for a 20-year tax holiday for gift city. So there are some of the GCCs in these four categories that perhaps may also be set up in gift city, if not in all categories. Certain categories can set up GCCs in gift city as well. So it might so happen that MNCs today, there may there may be situations where MNCs may have mega GCC in India already providing these four categories of services. But then there is nothing stopping to set up another additional unit in Gift City, say for accounting services or other services that are prescribed out of Gift City and availing the benefit of the safe harbor margin also, as well as the 20-year tax holiday in Gift City.
Very much insightful, Nilesh. I think you have given a very good piece of advice in advance of the coming in force of the safe harbor rules and how um, uh, tax effectively under the four corners of the law, under the mechanisms which are available in India, how we can benefit out of gift cities and how we can structure and shape up our GCCs. Nilesh, one point is always which we have been discussing is on the permanent establishment exposure for GCCs. So, although there is a safe harbor margin of 15.5% right now, the rules do not prescribe for um, any kind of circumstances or situations which should be satisfied, like for or any kind of rules which are flouted. For example, expatriate visits. How is it going to impact the 15.5% margin? The assumption which I am taking is if nothing is mentioned in the rules, then it means you have a GCC. Of course, it's quite natural that the GCC will require support from the shareholder, from their overseas entities, because the GCC is operating to support the overseas group, for them to make visit, to have a setup done, to have a regular guidance being provided to the teams as they have to support the day-to-day operations and functions. So the expected visits are always going to happen. They're going to happen in much more now, I think, because of the safe harbor rules, because to derive efficiency out of the GCC in India. But how is it going to impact the PE exposure? Or is it something to say that fine, there is a 15.5%, looking into the Supreme Court's ruling, it's an arm's length price, which has been very well accepted by the revenue authorities. Everything, even if there is a PE, everything is being remunerated well. Your views on this aspect, Nilesh?
So, look, you have touched upon a question which is now being asked by many GCCs, and this question is emanating from the Supreme Court judgment of Hyatt, according to which if a non-resident exercises all pervasive control over its Indian subsidiary, then in that situation, that might lead to permanent establishment. Now, take a situation where there is an MNC having a GCC in India. Obviously, there will be shareholder activities, there will be stewardship activities which you spoke about, and ordinarily this should not give rise to concerns on permanent establishment. But what happens if the control goes beyond what is a shareholder function or stewardship function? So, for instance, if the MNC or the headquarters is, for instance, deciding the KPIs of the Indian personnel, the headquarters is doing the appraisals of the Indian personnel, the headquarter is also going to decide the hikes and bonuses of the Indian personnel, and the Indian board is really not playing an active role, then there may be concerns on permanent establishments. There are also situations wherein Indian people sitting abroad are having global roles. So there are people sitting abroad who are reporting to Indians. That may also lead to a place of management in India. Now, we have two Supreme Court judgments, Morgan Stanley and E-funds. In Morgan Stanley, it was held that if there are expatriates visit to India, that may lead to permanent establishment. But if the GCC has been remunerated on an arm's length basis, then in that situation, there won't be any additional profits left to be attributed to India. The income tax department is contesting this position because this is not even as per OECD. We'll have to see how this plays out in the Supreme Court in the next round of litigation. In case of e-funds, basis facts before the Supreme Court, it was held that there is no permanent establishment. Having said so, it is important that the angles which I mentioned, overseas folks taking day-to-day reporting from the Indian personnel taking day-to-day reporting from overseas kind of colleagues. All of this should be evaluated in detail, and risk mitigation steps should be put in place to mitigate any additional risk of permanent establishment.
So, Nilesh, here I see that although the GCC's rules are in place, a very good initiative by the government, but still the contemporary or what we call traditional issues of the international tax, say the PE aspect, the arm's length price aspect, the shareholder function, everything is required. It's not something that it's sacrosanct that I'm opting for the safe harbor rule and I can do anything. When the investor also need to respect that what is the intention of these safe harbor rules, and only then all the operations should be evaluated and set up and then be applied for. Here, Nilesh, a point on GAR and JAR also comes to my mind. Fine, the PE issue will be litigated. It could be litigated. I'm not saying it will be litigated. But what about imposing of GAR when we just now spoke about global restructuring? What about judicial review of these structures and coming out something more than the existing safe harbor rules to safeguard the interest of revenue and of the country? Your thoughts on that?
So after Tiger Global has applied GAR to Mauritian-based investment structures, there is a crying need from certain quarters of the industry to issue FAQs and guidance in terms of what all situations will GAR apply and where all GAR will not apply. It will be useful for the CBDT to evaluate FAQs which can address different questions of the industry that will help to provide a stable and more informed tax environment in India. So it is important, Alok, for industry associations to make representations to the government, share all possible situations where there are doubts, questions, etc. And I'm sure that the government will evaluate and assess where all FAQs might be necessary. Again, as I mentioned, the government is in mode. Rarely has there been a situation where we found that any government anywhere in the world is so very much accommodative to listen to the concerns of the industry. In fact, as we speak, the Central Board of Direct Taxes has started extensive consultations with all stakeholders in relation to the finance bill provisions, in relation to the draft rules, the draft forms which have been prescribed for the new Income Tax Act. So I would encourage industry to have a discussion with the government. And I'm sure many, if not all, concerns will be addressed.
Thanks, Nilesh, for these your practical insights onto how these things are going to shape up and how government is going to extend its further support. Um, with this, Nilesh, we have already discussed the technical topics, the litigative topics which could arise. One thing very important, the compliance part. Let's come to the compliance part because everything starts from the compliance. The forms have been prescribed for to apply for these safe harbor rules. In parallel, we also have a 3CEB to be filed, which is form number 48, if I'm not wrong, under the new rules. And form number 49 is for the safe harbor rules. Both seems to be brothers and sisters in that way, following each other. So how would these forms are going to have an interplay with each other? How the revenue authorities are going to look into the details which have been filled up in 49? I suppose details, much more details will be required to be filled in even for the GCC in the 3CEB in form number 48. So your thoughts on how one has to look into what cautions one has to take while filling up these forms.
So look, in form number 49, which is for the 15.5% safe harbor margin, that will be for the four types of services that we spoke about. So the services will be services that are exported by the GCC to the overseas jurisdiction. Whatever services are encompassed in form number 49 will also have to be reported in form number 48, which is kind of equivalent to form 3CEP. However, form number 48 requires far more details as opposed to what were required in 3CEP. So apart from the export of services, what form number 48 also requires is reporting for any free of cost support that is provided by headquarters to its Indian GCC. To give you a simple example, if software is licensed by an overseas parent to its Indian GCC, then that will require to be reported in form number 48. If any free training or any free asset is provided by the HQ to the GCC, that too will be required to be reported. Now, obviously, such free of cost support is not forming part of form number 49 as such. So while the export of services may not be subject to transfer pricing audit, but if there are other international transactions, for instance, free of cost support, and depending on the facts, that may be subject to audit. It all depends on what position has been adopted by the GCC in its income tax return vis-a-vis any other services that are forming part of form number 49.
Okay, understand, Nilesh. So it will be very interesting when we start filling up the first forms, Form 48 and Form 49, how authorities are going to look into it, what kind of questions will be posed by them, and how we answer them. And I think it will take a bit more time for everything to settle down. And it's a good thing that the Indian tax space is never, you see, empty of any action. I'm sure there would be some action around it, which will keep us.
As well.
Yes, Nilesh.
The idea is to ensure that there is certainty and stability in terms of tax environment in India, and that India continues to shine as what we see the sunshine behind you as well.
This is a reflection on this rock basically. This I'm sitting facing the east, and it's the reflection. And I hope the way this is being reflected in the very same way. Uh, Sun is the government of India, which has come out with these safe harbor rules with an intention to nurture everyone. The rocks are the investors, and this sunshine which is reflecting on these rocks is in a sense of prosperity which is going to come to India when much more GCCs are being set up in India, and India becomes the GCC capital of the world.
And look, before we leave, please give a warm hug on my behalf to Brandy and Krishna as well. I know this is a very boring topic. I have taken you away from them for last 20 minutes or so. But please apologize on my behalf and give them a warm hug.
Thank you so much, Nilesh. I'm sure definitely they would have got bored, but the whole intention was to have some kind of adventure and some kind of tax studies as well, because morning time actually suits both the activities. So how wonderful to have talk with you, and how wonderful it's going to have some kind of gallop with them. So now I'll conclude the talks with you, and we'll try to do some gallop towards my farm. Thank you so much, Nilesh. We'll